Blockchain Basics 101, the Stablecoin. Welcome to Blocked Out. This channel was created to educate those who newly entered the market and are eager to learn about blockchain technology. The goal is to further adoption of blockchain technology, discussion, and disruption of the current trend. Let's talk about stablecoins. What is a stablecoin? What does a stablecoin do? Stablecoins are a type of cryptocurrency that are pegged to the value of a fiat currency, commodity, or other asset. This means that the value of a stablecoin is directly tied to the value of the underlying asset, which helps to reduce volatility and make them more stable than other cryptocurrencies. There are several different types of stablecoins, each with their own unique characteristics. Some stablecoins, such as Tether, are pegged to the US dollar, while others are pegged to other fiat currencies such as the euro or the yen. There are also stablecoins that are pegged to commodities such as gold, and others that are backed by a basket of assets. Stablecoins can be created and maintained in a number of ways. Some stablecoins, such as Tether, are issued and backed by a central organization, while others are created through a process called collateralization, where the stablecoin is backed by a reserve of assets such as crypto. Stablecoins have grown in popularity in recent years and have been used for a variety of purposes, including trading, remittances, and as a store of value. However, stablecoins have also raised concerns among regulators, who are worried about their potential use for money laundering and other illicit activities. As a result, legislation has been proposed in several countries aimed at regulating stablecoins and their use. This legislation is still in the early stages and is likely to continue to evolve as stablecoins become more widely used and understood. Currently, stablecoins are a promising development in the cryptocurrency space, offering a new level of stability and utility. However, as with any new technology, there are also concerns and questions that need to be addressed as the industry continues to grow and mature. What is a pairing, and is that stable asset really paired to the fiat currency? A pairing refers to the relationship between two assets, typically a cryptocurrency and a fiat currency, such as the US dollar or another cryptocurrency. In the context of stablecoins, a pairing refers to the relationship between a stablecoin and the fiat currency or other cryptocurrency that it is pegged to. A stablecoin is considered to be paired to a fiat currency when its value is directly tied to the value of that fiat currency. For example, if a stablecoin is pegged to the US dollar, then 1 unit of that stablecoin should always be worth $1. It is important to note that not all stablecoin are fully backed by the currency it is pegged to, which means that the stablecoin issuer may not hold a reserve of the fiat currency equal to the amount of stablecoin in circulation. They may hold a fraction of the currency in reserve, or they may use other methods to ensure the stablecoin maintains its peg. Some stablecoin projects may also claim to be fully pegged to a fiat currency, but may not be fully transparent in their reserve holdings, auditing, and issuance process. In this case, it's important to do your own research and due diligence before purchasing or using any stablecoin. Basically, a pairing in the context of stablecoin refers to the relationship between a stablecoin and the fiat currency or other cryptocurrency that it is pegged to. Not all stablecoin are fully backed by the currency they are pegged to, and some may not be fully transparent in their reserve holdings, auditing, and issuance process. This is where we need to take the conversation. Let's talk about fiat. We are going to cover a few different topics including: what is fiat currency, what is the Federal Reserve, and how does the Fed work? Fiat currency is government-issued money that is not backed by a physical commodity, such as gold or silver. The US dollar is the official currency of the United States and has been in circulation since 1792. The Federal Reserve, also known as the Fed, is the central banking system of the United States. It was created in 1913 to provide stability in the financial system and to promote economic growth. The Fed works by controlling the money supply and interest rates through a variety of tools, such as open market operations and setting reserve requirements for banks. A stablecoin is a type of cryptocurrency that is pegged to the value of a fiat currency, such as the US dollar. The idea behind stablecoins is to provide a stable store of value, as the value of most cryptocurrencies can be highly volatile. In order to ensure that a stablecoin is truly pegged to the value of a fiat currency, there must be proof of reserves. This means that for every stablecoin in circulation, there must be an equivalent amount of the fiat currency held in reserve. So a stablecoin is paired to a fiat currency, and it is supposed to be backed by that currency? Yes. What is proof of reserves? Proof of reserves is important in stablecoins because it ensures that there is liquidity in the market, meaning that there is an actual value behind the stablecoin. Without proof of reserves, there would be no way to extract real value from the stablecoin, which would make it worthless. Now that we understand the basics of stablecoins and fiat currency, let's talk about the major stablecoins. 3 major stablecoins are Tether, USDT, US Coin, USDC, and Binance USD, BUSD. Tether is pegged to the US dollar and is the most widely used stablecoin. US Coin is also pegged to the US dollar and is issued by the Center Consortium, which is a joint venture between Circle and Coinbase. Binance USD is also pegged to the US dollar and is issued by the Binance Exchange. What is Tether USDT? Tether USDT is a stablecoin that is pegged to the value of the US dollar. This means that for every Tether token in circulation, there is an equivalent amount of US dollars held in reserve. This helps to maintain a stable value for Tether, as the value of the token is directly tied to the value of the US dollar. Tether is issued and backed by Tether Limited, a company that claims to hold a reserve of US dollars to back every Tether token in circulation. This reserve is intended to provide assurance to Tether holders that the value of their tokens will remain stable, and that they can redeem their Tether for US dollars at any time. Tether is a widely used stablecoin, and it is considered one of the most popular stablecoin in the crypto market. It is used as a trading pair on many crypto exchanges, and is also used for remittances and other purposes. However, there has been some controversy surrounding Tether, as the company has faced criticism and legal challenges over its claim to hold a full reserve of US dollars. Tether has also been under scrutiny over its relationship with the crypto exchange Bitfinex, which has been accused of using Tether to manipulate the price of Bitcoin. Tether is a widely used stablecoin that is pegged to the US dollar and is issued and backed by Tether Limited. While there has been some controversy surrounding the company and its claims, Tether remains a popular choice for those looking for a stable alternative to other cryptocurrencies. What is USDC USD coin? USDC USD coin is a stablecoin that is pegged to the value of the US dollar. This means that for every USDC token in circulation, there is an equivalent amount of US dollars held in reserve. This helps to maintain a stable value for USDC, as the value of the token is directly tied to the value of the US dollar. USDC is issued by Circle, a company that is backed by Goldman Sachs and other investors. USDC is built on the Ethereum blockchain and is an ERC20 token, which means it can be stored and transferred using any Ethereum wallet. One of the key differences between USDC and Tether is that USDC is fully transparent and auditable. Circle has partnered with several companies such as Grant Thornton to conduct regular audits of the USDC reserve, providing assurance to USDC holders that the value of their tokens is fully backed by US dollars. USDC is widely used in the crypto market and is considered a reliable stablecoin. It is also supported by various centralized and decentralized exchanges, wallets, and lending platforms. Overall, USDC is a transparent and fully auditable stablecoin that is pegged to the value of the US dollar and is issued by Circle. USDC is widely used in the crypto market as a stable alternative to other cryptocurrencies and is backed by US dollars. What is BUSD Binance USD? BUSD Binance USD is a stablecoin that is pegged to the value of the US dollar. It is a digital token that aims to provide a stable store of value and can be used to trade against other cryptocurrencies on the Binance platform. BUSD is issued by Paxos Trust Company and is fully collateralized by US dollars, which means that for every BUSD token in circulation, there is an equivalent amount of US dollars held in reserve. This helps to maintain a stable value for BUSD, as the value of the token is directly tied to the value of the US dollar. BUSD is an ERC20 token, which means it can be stored and transferred using any Ethereum wallet. Binance, one of the largest cryptocurrency exchanges in the world, acts as a market maker for BUSD, providing liquidity and stability to the BUSD/USDT trading pair. BUSD is also gaining traction as a payment method and can be used to pay for goods and services on Binance's merchant platform, Binance Pay. Overall, BUSD is a stablecoin that is pegged to the value of the US dollar and is issued by Paxos Trust Company. BUSD is fully collateralized by US dollars and is supported by Binance. It can be used as a store of value, for trading and as a payment method. Currently, USDT has a $37.34 billion market cap with $67.33 billion circulating supply. USDC $43.5 billion market cap with $43,498,263,372 USDC circulating supply. And BUSD has a fully diluted market cap of $15,765,418,982 and $15,763,099,285 BUSD circulating supply. The important focus with stablecoins should be in the proof of reserves. Without proof of reserves, there is liquidity to extract real value from that asset. Without real value, what are we really doing here? Stablecoins are a great way to move in between assets and to shelter from an incoming storm or bear market. There are also very interesting strategies involving stablecoins, yield farming and liquidity providing. Stablecoins, yield farming, and liquidity providing are all relatively new concepts in the world of cryptocurrency, but they are also very interesting strategies that can be used to earn a return on investment. Stablecoins, as the name suggests, are digital assets that are pegged to the value of a fiat currency, such as the US dollar. This means that the value of a stablecoin is relatively stable, making them a great option for investors who want to avoid the volatility of other cryptocurrencies. Yield farming, on the other hand, is a strategy that involves lending out digital assets to earn a return on investment. This is typically done through decentralized finance, DeFi, platforms, which allow investors to lend out their digital assets and earn interest on them. Yield farming has become increasingly popular in recent years, as it allows investors to earn a return on their assets without having to sell them. Liquidity providing is a strategy that involves adding liquidity to a market, typically a decentralized exchange, DEX, in order to earn a return on investment. This is typically done by depositing assets into a liquidity pool, which can then be traded on the DEX. The returns are generated through trading fees, which are shared among the liquidity providers. Combining these three strategies can yield some interesting results. For example, by using stablecoins as collateral, one can lend them out in a yield farming strategy, and also use them as the base currency in a liquidity pool. This way, the investor can earn returns through interest and trading fees while maintaining a stable value of their assets. In conclusion, stablecoins, yield farming, and liquidity providing are all interesting strategies that can be used to earn a return on investment. While each strategy has its own unique set of risks and rewards, by combining them in a thoughtful manner, investors can potentially maximize their returns and minimize their risk. However, it's always important to do your own research and due diligence before investing in any strategy. I always want to state that this is not financial advice. Our channel is here to educate on basic and strategies using blockchain technology. We are not telling you where or how to invest your money. This video is for educational purposes only and should not be taken as financial or investment advice. The views expressed here are the speaker's own and not necessarily of the YouTube. Always conduct your own research and consult with a financial advisor before making any investment decisions. The company shall not be held responsible for any actions taken based on this video. Blockchain technology and investments in it are highly volatile and come with high risks. You could get wrecked. Thank you for watching. Please crush the like, comment, share, and subscribe.